Alrighty, welcome you all to the CIBC Winter Workshop. This is actually a narration over the 4 slides, which were not recorded. And so this is just a very brief overview of what we talked about and also taking stock of where we are at going into the spring semester. So what is the itinerary for the presentation and for the winter workshop? Well, first things first, we wanted to recap and touch over some of the different valuation methodologies, which would wrap up the technical portion of our investment banking recruiting journey. Number 2 is we wanted to provide a little bit more perspective on the process, and then also talk a little bit more about interview preparation. And so we do all of that in the presentation portion of the workshop, and then finally part 4, we would move on to a Lululemon case study where we provide an Excel spreadsheet for you all to fill out and hopefully get some more reps under your belt regarding all of this technical information. Okay, and so now let's talk a little bit about where we're at, where we're going. So we started last semester giving a broad overview of the investment banking recruiting process, talking about the different documents, behaviorals, bits and pieces involved when we're applying to investment banks. Today, what we wanted to do was go over part 2, the analytical, the technical portion of the investment banking process. And so over this winter break and then also last semester, you had the introduction and could dive a little bit deeper into the accounting, corporate finance, valuation components of the investment banking technical recruiting questions and process. And so we'll recap some of those here today and dive a little bit more into detail about the valuation and modeling portion of the questions you may see. So yeah, when we combine the objectives, part 1, the fit, the analytical, and then also the subtext components of this investment banking roadmap, wrap it all up together in a nice bow, then we can come into the spring semester with a pretty good idea and a pretty good set of tools with which to approach the investment banking recruiting process. So being a little bit more specific with the presentation today, we'll spend about 30-45 minutes recapping and going over some new concepts, and then we'll hop into breakout rooms to talk about the case study and provide some one-on-one support and answer questions. The hope is with understanding the concepts and getting reps and practice in this winter workshop, you will be introduced to essentially all of the different topics that are involved in the investment banking recruiting process. And by practicing more, having more exposure to what's going on and putting the pieces and the vocabulary together, you will be able to put together a better investment banking recruiting package. Okay, let's just jump into it. Topic number 1, overview of key concepts. What is valuation? All right, that's it for the 4 slides that were not presented in the presentation. What follows is the live Zoom. That takes about 2 hours discussing all these topics and going over investment banking. Hope you all enjoy. Okay, so those are the different valuation methods. Now I'll try to run through the other slides pretty quickly. So again, like we talked about earlier, the different strengths and weaknesses to different valuation methodologies, each carrying a different set of assumptions that are not explicitly stated, but in the way we conduct and we process different models and understand different companies, we're making these assumptions about that valuation method and that company. I think the easiest way to understand is perhaps understanding a valuation of art versus a valuation of some mature company, say that makes, like Coca-Cola, for example. So with art doesn't necessarily produce a very clear source of revenue that I can model out in the future. And so when I'm making this decision about which valuation methodology to use, I need to understand what are the parameters of that company, parameters of that object, and use the valuation method that best fits for that company or that object. So for art, for example, I don't have a clear idea about how do I model out different cash flows from that piece of art. And so I may use comparable companies or precedent transactions to understand where that piece of art, that value, falls relative to other pieces of art. Coca-Cola, on the other hand, produces clear cash flows over time, and I can generate a clear model for how I want to go about breaking down that company, projecting out the cash flows, and ultimately understanding what's the worth of that company today. And so you can imagine I could use the discounted cash flow analysis, which implicits certain assumptions I have about the company, about its revenues, takes that to the present day, and enables me to identify what the worth of that company is. So different strengths and weaknesses to a broad set of different valuation strategies. We have these different frameworks we can use to understand the value of companies, and then different tools we can use to analyze and process each of those valuations. So kind of talked about this a little bit. So I'll run through this really quickly. Just different valuation methodologies. Again, pulling all together, what we really want to understand is what the heck is this company, is this object worth? And use different tools, generate different questions so that we can reach whatever that conclusion is. So if we just quickly look through some of the valuation methodologies, again, this is just kind of a reference point for where they'll fall based off of the different valuation methodologies you choose to use. But the different assumptions that you implicit in the valuation model you use will necessarily result in different valuation ranges and also valuation means and medians. So very much keep this in mind, try to develop an understanding for this. I think it's one of the big questions you'll find in the 400 investment banking into Wall Street investment banking questions. And so something to know. Really quickly, what the heck is valuation used for? They use it in initial public offerings, equity offerings, debt offerings, M&A, and then also research. At the end of the day, all of these questions are just asking what the worth is something for a specific end. And so if I'm trying to take my company public and trying to communicate to the public, what the heck is my company worth? Of course, I want to run certain valuation models and understand where that pricing can fall in the stock market or what have you to define for the public what this value is. All right, so some main concepts. What are the goals of the different methodologies you have? So we have these broad frameworks of methodologies we could choose from. We have our set of tools, whether that be accounting principles or different metrics we have. And then we have our end goal. What exactly are we working toward? Well, we're working toward the worth of a company, defined as equity value for shareholders or enterprise value for all stakeholders in a company. And so step by step, we choose different methodologies, bring in a different set of tools for that specific methodology, and try to get to the goal of the equity value or the enterprise value for whoever we're trying to model the worth of that company for. And so again, we use some financial performance measures, some tools, whether that be sales, EBITDA, EBIT net income, what have you, to reach that, that holy grail of the equity value and enterprise value, which is the goal of our valuation model. All right, we talked about some goals and tools. I'll quickly run through some of these. We've talked about these in our past presentations. Quick recap. So again, what we want to get to, what is our goal? Enterprise value and equity value. Now we have different ways to calculate this based off of the set of parameters we define for the company, what the company is, what it does, and who we're looking at. So enterprise value for all shareholders in the company, equity value just for the equity shareholders of the company. Calculating market value. So at the end of the day, when we want to make that 1-0 decision about whether or not to purchase a company, to invest in the company, we have to have a sort of benchmark to measure what our assumptions, what our valuation model says, and whether or not we should purchase. And so calculating the market value of the company helps us establish a sort of benchmark for us to evaluate whether or not to make that 1-0 decision. Okay. We'll talk a little bit more about this today, and you'll have some time to do this in the Excel spreadsheet. But when we're calculating market value, we're trying to take in all the different factors that help us value a company. We have different options, different restricted stock units that will increase or decrease the number of outstanding shares of stock. And so there's this conversion that takes place within our benchmark number to help us understand and help us get a clear, accurate idea of whether or not to make a 1-0 decision. And so this dilutive securities on market value is a tool that we use to get a clear, precise benchmark for us to make that 1-0 decision. A little bit more about calculating enterprise value. What are the different tools necessary to get there? What are the different components? And then how can I take my information from my accounting knowledge and my valuation knowledge to plug that into one of the end goals we have? And then another tool we have for a more shorthand definition of free cash flow, albeit it's not the same, and understanding some of a company's operating financial metrics. So just tying it all up, what did you all learn in the past couple, the last semester, and also moving to this semester regarding technicals? Well, we have a broad set of valuation measures, models that we can use to answer the underlying question of should we or should we not buy, invest, or pass on this company, this project, what have you. And then we have our set of tools and set of concepts that we use to evaluate those questions, choosing from the different valuation methodologies we have available to us. Those valuation methodologies have different assumptions baked into them, and specific companies, specific objects will fit more towards specific valuation methodologies, so you could use all of them to evaluate whether or not to purchase a company. And so that was kind of that football field chart we had at the beginning. Now I'll hand it off to Owen to talk a little bit more in depth about some of these specific valuation methodologies. And then Cooper later on will talk about specific valuation methods that we hadn't touched on as much.
So I'll be a little bit briefer, perhaps than Cooper, just to, hopefully this part will be a lot of review, kind of similar to what Kevin was talking about. So first we have comps here. Next slide, if you could. Who's controlling the slideshow? Okay. And so basically the idea with comps is that you're given a company and you basically look at its peer sets and think about how investors are valuing those companies, based on their market prices, and then imputing that that sentiment that investors have about other companies, and asking what would my company be worth if it was viewed in the same way as this set of other companies that you've decided to focus on. And so we use multiples to come to those decisions. And multiple, you have in the numerator, you have a stock, meaning something that's fixed. It's not annual, so that can be like the total value of the company. Amazon or Apple's worth $3 trillion in equity value, so that's the numerator. And then in the denominator, you have something that's annual, something that's related to the operations of the company. So maybe that's revenue, maybe that's EBITDA, maybe that's even something like the number of oil rigs that your company has, the number of employees. And so those statistics are going to be what you're using to compare between companies. And next slide. And so here's what we would describe as like a comp spread, or it's a pretty common chart that many of you already seen, so I won't belabor the point, but you can see there's, for the most relevant multiples on the right here, you have the range showed with a high, an average, median, low, and then our target company that we're using to value, that we're doing this analysis on, will be at the bottom. and you'll be able to see ultimately what the company should be trading at based on this list of companies up here that we've decided to choose as comparable companies. And so we have a similar process that we can use as just public comparables, but with acquisitions. And so acquisitions are helpful to us because they represent actual transactions where a company wants to buy another company, and that deal actually happened. And the thing about mergers, which is oftentimes as investment bankers, what you're doing your valuation, like why you're doing your valuation, because the buyer needs to understand, or the seller needs to understand what their valuation should be. In a merger situation, a lot of times there's going to be something called a control premium, and that's a pretty common term you're going to be hearing in the process or just in general. And a control premium represents the additional value that the acquirer hopes that they can create by controlling the acquired company. So when Facebook bought Instagram, they had to pay a control premium, and Facebook could justify paying that higher price because, being Facebook, they think that they could make Instagram more profitable into an asset that's worth more as a part of Facebook than on its own. And oftentimes control premiums can be the results of synergies. So maybe Facebook can help Instagram control their costs better because they have more experience operating in this area. Maybe Facebook can help Instagram grow by integrating Instagram into the Facebook network, and that would be something called a revenue synergy, where 2 + 2 = 5, because Facebook can help Instagram grow faster, maybe help negotiate with advertisers better. So those are the main two things that go into control premium. And the thing about acquisition comps you need to keep in mind of, though, is that there are points in time, in contrast to the general public comps method, because public comps method, you're going to be looking at data from the most recent period that you have access to, whereas, and that could be like a couple of weeks ago, whereas acquisition comps, it could be, Facebook, Instagram happened a while ago, and maybe the dynamics of the market were very different back then, and it might not be, a relevant piece of information to what might happen in the future. So you have to be mindful of those things, along with a couple other factors here that we've identified, but I won't go too deep into those for the moment. And so in terms of what to look for when you're valuing a company in the context of an acquisition and looking at prior acquisitions for your comp set, you really want to be considering all of those factors that are outlined there, because those can contribute to synergies. They can contribute to the overall story of the transaction, and all of those things, they really factor into the price that's going to be present in the precedent transaction. And it's going to be really key to informing like which ones you choose and which ones you focus on. And it's the thing about acquisition comps is you really need to be able to craft a story for why this prior deal makes sense in the context of your potential merger. And so here we see a list of different transactions. You can see the acquirer on the left, the acquired company on the right. And again, similar layout to public comps with the multiples paid. And you're going to want to take a median and use that as your central estimate, and then create a range from the other ones. And then now we have DCF, which is probably the most heavily focused on in terms of interview questions. So definitely be familiar with this one. We'll go through quickly the broad assumptions again. So the DCF measures intrinsic value, and that's based on baseline assumptions about the company's financial operating statistics and its growth. What is it like actually should be valued, and that's kind of independent of any external factors like the market, its competitors necessarily in a pure sense. So you're really focused on the company itself as opposed to what it's worth compared to other companies. And typically when we do a DCF, we're focused on unlevered free cash flow, which just means we're not going to be focusing on the capital structure or how much equity versus debt they have necessarily. We want to focus on the free cash flow that's available to everyone, because that's going to be what's mattering to enterprise value. And in a DCF, we're going to be looking at the present value of the company's future free cash flows, their future operating statistics, and then that combined with their terminal value, because we are only going to have a limited forecast period, and we want to account for the fact that Apple's going to exist 20 years in the future, probably, even if we're not making explicit predictions about what they're going to be doing past maybe 10 years. And then, of course, we have a discount rate, which is probably the most important, that you'll get the most questions on, which is going to be the WACC, the weighted average cost of capital. And we'll cover that in the next slide or the slide after that. But just quick review of the advantages of a DCF. It's intrinsic, so it's you can directly ascribe a number to it that's that it should trade at, and if you believe in the efficient market hypothesis, eventually in the long run you will be right, because you're valuing an asset based on what the asset is actually worth, not based on what it's worth relative to competitors. The DCF is also pretty flexible. You can be really creative in terms of how you're deriving revenue, in terms of how you're projecting out what you think is going to happen to the company, and you can get really into the weeds if you want to, which is probably less common in investment banking than maybe if you're at a hedge fund. But I think that's just an important thing to note. And you're really focused on a few key drivers, which will be, your revenue, your free cash flow, and then your discount rate. So that's kind of the advantages, I would say. So key considerations, as I was kind of just mentioning, your model is going to be highly sensitive to your forecast, what's in your forecast, how much free cash flow are they going to actually generate. And so inherently that's can be problematic, because you really have to make sure that your forecast is good, because oftentimes, that's the most important thing. Your discount rate can be important. And it's definitely probably the second most important thing that goes in your analysis, but you need to be reasonably accurate about how your company is going to perform during your forecast period. And that's kind of why the DCF is oftentimes most useful for companies that you can project out a reasonably stable cash flow, like Kevin was mentioning earlier about Coca-Cola. It's less useful maybe if you have a crazy high growth company, like a startup or something, and who knows what they're going to be doing in 10 years. Maybe they'll be bankrupt, maybe they'll be the next Amazon. So your forecast period, that's really important, because that's most of what your analysis is based on. And then we have terminal value. Oftentimes terminal value can be up to 40-50% of your overall value. And so your assumptions about how that company is going to grow in perpetuity, or what exit multiple you're going to use, that's oftentimes really important to your overall finding. And again, as we mentioned earlier with the football field, we really want to use a range of estimates because it's really about a yes or no decision. So it doesn't really matter if you're off by 50 cents, as long as you're making that decision that overall directionally turns out to be correct. And so here we have the discount rate, or WACC. I think this is like a very key thing to wrap your head around conceptually. Oftentimes you'll get something as basic as what is WACC, but it's important to understand what drives each of these different variables and how real world events might change them. So I guess I can start with the cost of equity. So to find the cost of equity, we usually use the CAPM model. So the expected return that investors are going to receive, which to you as the company is the cost of equity. So you have the risk-free rate. No one's going to be willing to get less than a treasury. We have the beta, the levered beta, which is the volatility or the correlation between the company's performance and the overall market. And then something called an equity risk premium, which is how much are investors willing to pay for the risk of the stock market. So how much, maybe it's 7% a year for that investors are willing to, that they want to get from the S&P to take on that risk of the S&P. Instead of, as we see here, because it's being subtracted from the risk-free rate, how much are they willing to pay? How much are they willing to be paid to take on that extra risk when they could just be holding treasury bonds and taking no risk at all? And then we have the cost of debt. And really the key thing with the cost of debt is that you think about taxes, because interest is tax deductible. So we have a marginal cost of debt, which is oftentimes just given to you. How much does it cost for the company to borrow money? And then the after-tax cost of debt, you just get it by taking 1 minus the tax rate. And then to wrap it up, we have the WACC. The WACC is really the weighted average, as it might imply by the name. So you have the cost of equity times how much equity do you have over the whole company, and then added to the cost of debt times how much debt do you have in the whole company. And so just overall, it's important to understand how these things are changing. Like what is the impact of, what happens if beta changes? What happens if tax rate changes? What happens if the risk-free rate changes? So as you think about common interview questions that you might see that maybe you're not seeing in the guides, that's like playing around with this model. Like, what happens if this variable changes? What happens if that variable changes? That's a good way to, get outside the guides and understand these concepts on a more fundamental level as well. So here we have another discussion of beta here. So whenever I think we've covered this before, beta is going to reflect the levered beta is just going to reflect the volatility, the stock's volatility relative to the market. And you can find this pretty much anywhere online. You're not going to be asked to compute this. It's going to be given. But to figure out what portion of that risk is related to the actual business instead of the risk of the capital structure, namely, are they at risk of going bankrupt because they have too much debt? We're going to need to adjust the beta based on how much debt the company has. And you can see that formula here. So we have unlevered beta equals levered beta over 1 plus debt over equity times 1 minus the tax rate. So that's going to help us take out the impact of debt, basically, and then get to a more general metric that we can use to say this is the actual risk of the whole business. This is actual risk of the assets that the company owns, so the actual risk of the unlevered cash flows that the company is going to be receiving. And then once you've gotten this, I guess this is most relevant for doing comps, because oftentimes you'll be taking the levered betas of your comp set and then unlevering them, and then to find out the overall risk of the assets, and then relevering them to find out the risk of your company. You're going to be relevering it using this formula, and all these things are helpful to memorize. And again, really to figure out like what happened, to really practice by changing one variable and seeing directionally like what happens to the overall beta. Maybe tax rate changes. What happens to this equation, and what does that mean for the value of the company? That's like a great way to practice these concepts. And again, beta is important because it flows into CAPM, which we use to find the cost of equity, which we in turn use to find the weighted average cost of capital, which then flows into our DCF. So there's kind of like a cascading effect where maybe changing the tax rate, I mean, it's going to affect free cash flows too, because you're paying less taxes and taking home more money, but you're also, it's going to have implications on your cost of capital, which will change your discount rate, which will change the value of your total company. So it's kind of important to see how all of these things flow throughout, because these three equations are kind of connected linearly. And that's a pretty common interview question to really have the interviewee really show that they understand the process that you're going through to find the overall value of a firm in a DCF. So like being familiar with these equations and how they relate to each other is definitely very important. And then again, we have terminal value here. So there's two main ways to go about calculating terminal value. So first, we have the perpetuity growth method, which is probably slightly less popular, but very similar and not any less like valid. So the basic assumption you're making here is that the business is going to grow at a certain rate pretty much forever, or not pretty much, but forever. So I would say like memorize this formula maybe, but just as a basic idea, you're going to be like multiplying by 1 times the growth rate, and then subtracting by the WACC minus the growth rate. And if you study accounting and maybe look at an annuity formula, that'll be kind of familiar to you. But so that's one way of thinking about what's the value of an infinite and growing stream of cash flows in a more explicitly defined way. But the other way we can look at it is through an exit multiple. So basically what we're doing here is we're going to be taking the multiples that we covered earlier. So here it would be enterprise value to EBITDA, and we just take that number, say it's 10 times that we think the company is going to be traded at, and then we're just going to multiply the last year of our forecast period. So maybe that's year 10 that we're forecasting for our DCF, and then we just multiply that EBITDA number by the multiple, and we get the terminal value. So this second method, it's generally more used, especially in banking, because you don't have to make, like, sometimes the perpetual growth assumption is like harder to make explicitly. Whereas, the exit multiple method, you can oftentimes look around at your competitors and you can kind of get a more clear sense of what the range might be. It's oftentimes easier to present, but both of these ways, they're fundamentally based on the same theory. So I wouldn't say that one of them is like massively more accurate than the other, but the second one's more used. So that's probably one to get slightly more familiar with. I'll pass on to Coop.
Yeah, great. Thanks, Owen. So yeah, I just want to note that I understand if probably a lot of this seems confusing right now. I mean, it's only January. So this stuff will become more clear over time. And once we're done with this PowerPoint, we're going to go into the Excel, and hopefully that will show you all how kind of all these seemingly discrete components come together to form the bigger picture, whether that's WACC or beta or cost of equity, terminal value, exit multiples, all those terms, how those come in to form the bigger picture. So I think that'll be very helpful, but it's important to note that this should not be the first time you're seeing a lot of these terms. It's going to be a busy spring, so we kind of need to get cracking on some of this. If a lot, it's all new, most likely, but you should be getting familiar with these terms. And just the more kind of times you consume this knowledge and let it percolate through your brain, the easier it's going to become, and will just kind of know it like the back of your hand. So I'm going to start going into the kind of an M&A analysis, which is definitely a more niche kind of component of banking interviews. It's not very common to get questions on this, but the next section I'll do on LBO is considerably more common. So Kevin, why don't we just hop right in? So when we're doing an M&A analysis, we're really trying to see is how will one company acquiring another company affect the company after the transaction? So often, if you read the Wall Street Journal, you see a deal announcement. It'll always talk about what the projected earnings per share is going to be for the company, kind of the like forward-looking statements. It'll also talk about synergies. Is the company expected to generate $100 million in synergies 2 years out? Is the EPS of the combined company going to grow? So this is kind of the idea of like assessing the impact of the merger or the acquisition. So in terms of accretion dilution, which we're going to get into a little bit more, that essentially means that is the earnings per share of the combined company going to be greater or less than the EPS of the buyer before the transaction. So that's what you're trying to look at. Is the deal going to grow the earnings per share, or is it going to negatively impact the earnings per share? Obviously, you're not going to do a deal if the EPS is going to be dilutive to shareholders. That's not what you're going for. But an interesting note I think I'll make is that there was a research paper that came out in the Harvard Business Review a couple years ago that spoke about accretion dilution in M&A deals. And essentially, what happened was a lot of deals that were projected to be accretive in the long term turned out to be dilutive. And you might ask, like, why is that? Well, that's really because probably some of these management teams got a report that this deal, acquiring whatever company it is, was going to be accretive to the EPS. And they're like, okay, good, that's it. We don't really need to do anything. But deals that were projected to be dilutive, and sometimes companies will do these deals. I won't really get into that, but deals that were projected to be dilutive actually became accretive because management teams had to work to make a positive impact on the earnings per share. So yeah, why don't you go to the next slide, Kevin? So really, it comes down to this earnings per share rule that I'm talking about, and it's really the central component when you're looking at this analysis. And we'll get into on the next slide, Kevin, if you go, kind of what's, never mind, that's not the, it's a couple slides later. But so that's really all we need to say about the EPS. As we're looking at, is the EPS going to grow or is it going to shrink as a result of the merger or the acquisition? So when we're looking at an M&A deal, we have to separate the value of the company on the company's balance sheet versus the price that the company is paying to acquire the other company. So what we'll see is there is a pretty large difference between the price that's being paid for the company and the value of the assets on the company's balance sheet. So hopefully when you're going through some of your studying, and specifically the accounting guide, you heard about terms like goodwill and intangible assets, things of that nature. So what will happen, and this is kind of a more granular topic and one I remember being confused about early on, is there's this difference, right? Like I said, between the value, the price that's being paid for the company and the value of the net identifiable assets on the company's balance sheet. So essentially what happens in an M&A deal, and this is quite a common question, like what happens to the acquirer's balance sheet when they acquire another company? And so one thing you see is that they they basically increase the value of the goodwill and other intangibles on the target's balance sheet to justify the difference between what is being paid for them and what the assets are on their balance sheet. So if a company is acquired for, let's say $1 billion and their net identifiable assets on their balance sheet is only 500 million, you might be like, well, why are they being acquired for 2 times what is kind of worth on their balance sheet? And that kind of comes into what we were talking about earlier, the synergies, but they have to justify that residual value somehow. And the way they justify that is by writing up the goodwill and other intangibles. So what you'll see when a company acquires another, they will have a large increase in goodwill on their balance sheet. And that's strictly because they are writing it up to kind of plug that difference between the price that's being paid and what's actually on their balance sheet. And so I remember that being kind of a more confusing topic when I was going through this, but it's one of those things that if you're interviewing for kind of more advisory shops, you know, like a Rothschild or something, they do a lot of M&A. And so knowing what happens to the balance sheet in an acquisition or a merger is quite important. Kevin, why don't you go on to the next slide? So this PE rule that I was talking about, right? You might get a question like, if you're advising a company on acquiring another company, and the buyer's price to earnings multiple is greater than the target's price to earnings multiple, is the deal accretive or dilutive? That's one you should be ready for in an interview. And it comes down to this price to earnings rule, which can also be thought of as like earnings yield. So what we see is that when the acquirer's PE is greater than the target's PE, then the deal is accretive. And the flip side is also true as well. So this is like a trick you can use in interviews to be able to tell just very quickly, is a deal accretive or dilutive? And the reason why if the buyer's price to earnings multiple is greater than the target's price to earnings multiple, basically what that means is they're purchasing a greater earnings yield. So the earnings yield of the combined company will be higher than just the buyer's earnings yield prior to the transaction. So this is just kind of one of these things you have to do a little bit of legwork and understanding yourself, because it's quite easy to remember this PE rule, this kind of just rule of thumb for interviews, but knowing why this is so is quite important as well. And so it all comes down to the earnings yield of the combined company, which is that focusing on that EPS again, like we talked about a little bit earlier.
I guess I would add, like, you don't always use price to earnings too. Basically, what Cooper's getting at with the PE rule is the basic question that kind of is before we get to the PE rule itself is, based on whatever we're using to finance this transaction, like, because, you know, whether we are going to be paying cash, maybe we're going to issue stock, maybe we're going to issue debt, you know, all those things have costs to them. Whether it's an opportunity cost, like on the cash, like I'm not going to be earning interest on this cash anymore, or it's an explicit cost where I have to pay money to either to debt investors or to new equity investors so that we can afford to buy this company. So really the PE analysis, the PE rule is getting at, like, are we going to be able to make more by owning that company? You know, because we're getting that extra earning power. Is that new EPS going to be higher than whatever we use to finance the transaction? Like, is the yield on, is the return on the earnings that we're buying going to be higher than the cash that we're foregoing interest on to finance this transaction, than the additional interest that we're going to have to pay to be able to afford this, or the additional shareholders that we're going to have to take on to be able to afford this? That's kind of the key question that underlies the PE rule.
Yeah, so kind of what Owen was getting at there, like a question you might get are, what are the effects of an acquisition? You know, Owen mentioned like forerun interest on cash, additional interest on debt financing, you know, the dilutive impact of issuing shares. So this gets down to what he was saying about what kind of consideration are we using to acquire the company. If it's cash, you know, it's the forerun interest on cash. If it's debt, it's the additional interest on the debt financing. If it's shares, it's the dilutive impact from issuing additional shares to acquire the company. There's a couple more as well. You know, there's the write-up of the goodwill and other intangibles, and the wipeout of shareholders' equity on the target's balance sheet. And so that's like one kind of interview question that is kind of quite common. Like, what are 5 impacts of a merger or an acquisition? And so that would be the answer right there. And understanding kind of the bigger picture as well is quite important. So Kev, why don't you go back to slide 38, which is right before this, I think. No, go back.
Looks like, hold up. Google Slides does not like it when I go backwards. There you go.
Yeah, right there. So the next thing we'll talk about is a leveraged buyout. This is a term you probably hear a lot or see a lot when reading different newsletters, Wall Street Journal. It's quite kind of like a sexy topic, you will, the LBO. So really what it is at its core is just a financing technique for acquiring a company. So if we think about what we just went over in the section, in LBO is literally just a merger or an acquisition using a lot of debt. That's really kind of at its core what it is. So if you think of like one, and that's good to help conceptualize this, is what's like a real life scenario of an LBO. And that is like buying, using a mortgage to purchase an apartment. and then renting out the apartment and using those cash flows from the renters to pay down the debt, and then eventually selling the apartment. So that's what it comes down to, is using a bunch of debt to acquire something and then using the cash flows from that company to pay down that debt over time. And so we get into kind of this topic of, we talked a little bit about synergies earlier, and this brings into focus the idea of the difference between a financial buyer and a strategic buyer. Financial buyers are typically engaging in LBOs. So a financial buyer is a company that's buying or acquiring a company for strictly financial reasons. Whereas a strategic buyer is a company that's acquiring another company for reasons that maybe in addition to financial reasons, they are also able to benefit from increased market share, or they're able to reduce corporate redundancies, or they're able to benefit from economies of scale, right? Or they're able to get one of their competitors out of the market and benefit from less competition. So, you know, in an M&A scenario, a strategic buyer, a competitor, is going to be willing to pay more for a company than like a private equity firm who is only benefiting from the financial benefits. So oftentimes in an LBO, the financial buyer, a private equity company, will be willing to pay the least amount for the company. And so this kind of like it says, sets the floor of the valuation, right? So if we think about the 4 valuation methodologies, we have DCF, public comps, acquisition comps, and LBO. And so if we were to rank all 4 of those in terms of what's going to return the highest value and what's going to return the lowest value, the highest value is going to be the acquisition comps because of the control premium that's paid, like Owen talked about. The lowest will be the LBO, because financial buyers are often going to pay the least amount for the company. And then kind of in the middle, you have DCF and public comps, and those can be interchangeable depending on kind of what inputs or assumptions are used. So if we think about like a strong LBO candidate, which is a typical interview question and one I probably got 2 different times. Kev, can you hit next slide? Yeah, so a strong LBO candidate, right? We think about what would a private equity company who's going to acquire another company want? You know, they're a financial buyer, so they're purely interested in the financial success of the company. So they'd look for a company that has strong, predictable cash flow, right? And why is that? Well, that's primarily because they're using a ton of debt, maybe even like 70% debt to acquire this company. They need a company that's going to be able to generate strong enough cash flows to pay down that debt. That's central to what an LBO is. They need to be able to pay down that debt. They want a company that's mature, right? That goes in with being able to pay down that debt. It's able to kind of support that really bloated capital structure. They want a company that has limited capital expenditures, right? That is very expensive and can be considerably limiting to a company. Obviously, they'd want a company that is undervalued. I think that goes without saying. That's kind of with every M&A scenario. You want to buy something for cheaper than it actually is. And you see this mention of synergies, right? Oftentimes, like I said, it's thought that the private equity companies are not able to benefit from synergies, but sometimes what they'll do, and what you'll see quite often, is they will merge 2 of their portfolio companies together. And so then they're kind of able to benefit from both. So in contrary to what I said previously, just on its face, a private equity company acquiring one company, they don't benefit from synergies, but they can combine 2 portfolio companies to benefit from those synergies. So that's what makes a strong LBO candidate, right? One, that they're able to pay down the debt really easily. So that's one that has strong, stable cash flows. And they want one it's going to be easy to create value, right? Because that's where they make their money, is when they're able to create value. So a lot of times they fire a bunch of people. So private equity companies come under a lot of fire for that. They come in, they fire a bunch of people, they close a bunch of plants or stores or whatever it may be. A lot of people lose their jobs, but they're making companies more efficient to make them worth more. So if you go to the next slide, we think about value creation, right? One of those is, I kind of mentioned just a couple there, but paying down the debt, operating improvements, right? Increasing their market share, making the company, growing the company's margins, right? So that making the company more efficient, streamlining the company, so that they're left with more cash. Or expanding the multiples, right? So if they buy a company for 5 times revenue, whatever it may be, it'd be nice if they could sell the company in 10 years for 7 times revenue, right? So that's another way they can create growth, is by, or make money, is by growing the multiples. And quickly, the last slide is just a visual for what kind of this value creation looks like over time, right? You start with, let's say, you start with 30% equity, 70% debt. That's quite common. And what you're doing is making the company more efficient, and using those increased cash flows to pay down that debt and grow your equity over time. So that's really what it comes to down at its core. You can think back to that example of using a mortgage to buy an apartment or a house. And that's really just the same thing, right? Paying down your mortgage with the cash flows you get from renting that property to grow your equity in that property. So that's what it comes down to at its core. It's just, it's a merger or an acquisition using a ton of debt. And that's pretty much it. To close it out, some resources to pay attention to and to use to kind of stay on top of this stuff, right? Because these are all topics, but what you want to be able to do is connect them to real world scenarios. So come interview time, it's really important to be reading the news, right? Keeping up to date with the news and different events are going on. So Wall Street Journal, the New York Times, we get subscription to those through school. There are different podcasts or whatever there may be, or different newsletters. And that's important to connecting these technical topics to real world scenarios, right? So if you're asked in an interview to talk about a deal that interests you, right, you're able to tie your knowledge of M&A stuff together with kind of your knowledge of why a deal might be attractive in qualitative terms, right? So with synergies and that sort of thing. So another way to do this is speaking with alumni. When you're networking, you can ask about a deal they've done and get some insight into those deals that are oftentimes kind of kept private. So that's an important part, kind of an extra piece you want to add in. You want to make a habit out of trying to read the news every day, the market section of the Wall Street Journal. I still do that. That's a great way to keep on top of things. There's different newsletters. I'll shout out Liquidity, kind of a meme, but he has a great newsletter that it's basically just a bunch of bullet points about what's going on in the market. Great way on the morning of an interview to go through, see what's happening in the market. If somebody asks you, oh, did you see that this happened today? Then you're in the know of what's going on. So we'll close it out with that. I'm sure there are questions, so we'll kind of open it up for Q&A now. Everything's free game. What I'm going to do in the meantime is send out this Excel that we're going to work on. That'll take all of this and put it kind of be able to get your hands dirty with some of these topics and see how it all pulls together. So yeah, Q&A, have at it.
So I think Coop sent you all the empty version. But the premise of this, like, if you're, my Zoom is not liking my share screen. All right, let me try that again. My computer does not like it when I share screen sometimes. Okay, I think it's working now, but basically the premise of this, like the whole presentation and the workshop was literally like, if you understood most of the concepts from that presentation and then can relatively complete this Excel sheet, and then of course work on some of the behavioral and the technical questions, you're kind of set for the investment banking interview process. And so Coop spent a lot of time putting this bad boy together. But essentially, if you start on the first page and just go from left to right, slowly working your way throughout the sheet and filling in these yellow boxes, you can get a good intuitive understanding about, like Owen was saying, the cascading process of all these different numbers and equations. Albeit it will take some time to figure things out. So the main challenges here are, one, understanding how everything connects. So how to write the equations, what do the equations mean, what they do? And then a more intuitive level, what the heck is equity, enterprise value? What are comparable companies? And then the different valuation methodologies that we talked about today. So in the different technical guides, they sort of walk through piece by piece, like how to do this, albeit it's not everything's in there. And a lot of this is simplified for the purposes of making that intuitive piece more clear. So it will probably take like 1 or 2 hours, maybe more, your first time through if you're not too familiar with some of this stuff. But quite literally, like if you can do this and you can explain it to another person, that's really all you need for the investment banking interview process. And some more intuitive questions. I don't want to oversimplify. Does that make sense? Or any questions about investment banking interviews, anything in general? My time is your time.
When do we usually start getting like the technical interviews? Like how many interviews in is that?
Yeah, that's a good question. So it kind of varies from company to company. A lot of the elite boutiques, or what are designated as elite boutiques, start off with technicals quite early. So the first interview you may have will be like with one analyst, and there'll be a series of behaviorals like tell me about yourself, but they also might throw in like a few basic technical questions. As you move deeper, so they're typically 3 rounds, like a first interview and then another interview and a super day. And so the second and third interviews, you'll probably get some more in-depth technical questions, but the screener typically does not have that many. Like with what we were talking about in the deck earlier, the majority of your technical questions for a lot of banks are primarily going to be accounting and intuition questions. So like if we look at the spreadsheet on the financial statements, they might ask what happens when depreciation increases. Like you all may have heard this one already, when depreciation increases or decreases by $10. And then you have to give them like the step-by-step process about how you think about that. These things relating to discounted cash flow, leverage buyout, and M&A are typically more high level and don't dive it like super in depth to the details we talked about today, albeit you will get like 1 or 2 in the process of your interview or interviews at a given company about some more of the detailed questions. So that's kind of what we talk more about. So to answer your question, Virginia, like first, second round, you'll probably start getting technicals and they'll get more in depth as you go on. And then how do you want to be spending your time? 1, understand this broad set of things we talked about today. And 2, then focusing on you really understand the accounting, what equity versus enterprise value is, and basic valuation.
Okay, cool. Thank you.
Yeah. So what would be most helpful for y'all right now? Like, do you all want to work on this a little bit and then come together and talk about it? Or would be helpful for me to just provide a little bit of a step-by-step, walk through it a little bit so you guys get a general idea of what's going on, and then just feel free to ask a question to me, Coop, or Owen later. Do you have a preference?
Probably the step-by-step for me.
Okay. Same thing, Zach?
Yep, works for me.
All right, it's freaking rock and roll. So let's do it. If you all have any questions regarding any of these line items, like please ask now. It's better to ask now than to prolong and ask later. So really any of the concepts whatsoever, I will try to help walk through it. Let me also bring up the answer key. Where is the answer key? Sorry, give me a sec. And maybe this side by side will help out. So the right side is the fill in the blank and the left side is the filled in responses. So like, I think the main thing that's really important that Owen was talking about earlier is to understand that there's a really cascading effect to all of these things. So we start with like the different frameworks and the different valuation methodologies, but all these different pieces will feed into each other and eventually result in that final number that helps us ascertain whether or not we want to make that 1-0 decision. And so what we always start with are the different financial statements. And so this serves not only as a foundation for your valuation methodologies, but also some of the investment banking questions that you will get. How are we feeling about the financial statements, by the way? It would be helpful to run through an example of an accounting valuation, accounting question you get in an investment banking interview. Because I can do so.
Yeah, that would be good.
Okay, let's run through it. So of course you have your 3 different statements. You have your income statement, you have your cash flow statement, and then you have your balance sheet. And so one of the questions you may get is something like, what happens when revenue increases by 100? And so we can easily do this actually by just changing this number and say, oh, I guess it's not connected. Normally you would be able to see it by just changing the number and then everything changes within the Excel sheet, but just running through it. Literally what you do is go step by step through each of the 3 statements, explaining what would happen when there's a $100 change in revenue. So revenue goes up by 100. Because revenue goes up by 100, operating income or EBIT increases by 100. But then we need to factor in taxes. Let's say taxes are 40%. So 40% of that $100 increase is going to be given to the government. So we're only left with a $60 increase. So at the end of the income statement, we're only going to have that $60 increase. Now, what happens on the cash flow statement? Well, we know that the income statement and the cash flow statement are tied by net income. And since net income increases by 60, the beginning or starting cash that we start at increases by 60. Now, nothing else really changes throughout the cash flow statement because we're not really dealing with any of these items. So our net change in cash is going to increase by 60. So what do we have so far? On the first, on the income statement, our first financial statement, we have an increase of net income by 60. And on the cash flow statement, we have an increase of cash of 60. Now, how do we reconcile the income statement and the cash flow statement? Well, we go to the balance sheet. Basically, what we want to see is that the changes on the income statement and the changes on the cash flow statement, when we bring it to the balance sheet, fit this broader equation that assets equals assets plus minus liabilities equals net ownership. And so when we look at the balance sheet, well, when you look at cash, what happens to the assets? Assets increases by 60. Nothing happens to liabilities. And what happens to equity? Well, since the net income increased by 60, our retained earnings increased by 60. And so assets minus liabilities equals equity. The left-hand side of the equation, assets minus liabilities, increases by 60. The right-hand side of the equation, total equity increases by 60. And so because those two balance, we reach our conclusion that assets increases by 60, retained earning increases by 60, and everything is still within equilibrium with the three financial statements. So this is very much verbatim, like if you're asked an accounting question, there are different variations on the theme, but that's almost exactly the process that you'd go through to understand and explain to somebody like what exactly happens in an investment banking interview. Does that make sense? Or any questions about the question?
I think that makes sense, yeah.
Okay. And so what may be helpful, or what is helpful, and Zach and Virginia, you may have heard this from the people that you talk to. Really what they recommend is getting a partner or finding one of us and just asking some of those questions and processing them step by step through what happens on the three statements. It's kind of hard to do at first, but like as you get more reps, it starts to make sense. Okay, so we are always starting with the target financial statements. The next thing that we want to understand is what the heck is enterprise value and what the heck is equity value. Like we're talking in the presentation, like these are the goals. These are the things that we want to get to. And the key thing in the interview is they'll ask you, how the heck do I get to enterprise value? How the heck do I get to equity value? And what do those things mean? So quick test for you all. Do we know what equity value and enterprise value mean intuitively? If not, that's totally fine. But
Equity values is the value for shareholders, right?
the value of
And
what for shareholders?
Their ownership.
Yeah, the value of the company to the shareholders.
And then enterprise value is value for all stakeholders. So all forms of capital are included.
You got it. So why are they different? What does it mean if they're different? So as you're saying, Zach, the value of a company will be different based off of who's looking at the company. So if I'm a debt holder, like I don't want a company that's going to be super risky and might go bust. The value of that company is not as much as it would be to an equity investor who's perhaps looking for that 100x return and is okay with the company going bust. So we have these two different things, equity value and enterprise value, both measuring the worth of a company, but it's going to be different. The value is going to be different based off of who's looking at it and what our parameters for value is or are. And so we have different equations that we use to convert between equity and enterprise value and measure what that worth of the company is. So Zach, one of the questions you just answered there is essentially one of the fundamental things they'll ask you in interviews. What is the difference between equity and enterprise value, and how do you calculate it? Okay. Also, what may be helpful to understand is that equity value and enterprise value can be understood through the financial statements. So while their equations are not the same, intuitively why one is toward the equity shareholder and one is toward all stakeholders actually sees itself out within the income statement. And so when we start with revenue, this is something that's a little bit more abstract, but something that helped me understand enterprise and equity value. When we start at the revenue line, this is essentially income or the amount of money generated from a company's operations that is available to all the stakeholders. And so we take out the cost of goods sold, get the gross profit, take out SG&A, and we arrive at this thing called EBIT, this thing called operating income. Now, the story behind operating income is it's the amount of money the company has generated after you brought in the revenue and you took out all the costs from the company's operations. So this is still the total amount after I take out the costs of value within that certain time period available to all stakeholders. Now, what happens after that's pretty interesting. So as we keep going down the line item, we start taking out stakeholders because we're giving them their funding or their operating revenue. So we start with all stakeholders. Net interest, well, what's net interest? I'm paying the debt holders. So I'm taking the debt holders out of the equation. I have some random charges not associated with the operations of the company typically. I have to deal with taxes. So I'm taking tax holders or the government out of the picture. And what am I left with? Well, I'm left with net income, or the value generated by that company in a specific time period toward equity stakeholders specifically. So what exactly are we looking at when we look at an income statement? Well, yeah, we're looking at its operations and the costs and everything that's in and out of there. But what we're also looking at is where is the funding going to specific stakeholders and who is getting that funding? So interest, debt holders, taxes, government. At the end, we're net income given to the equity stakeholder. And I'm going into the weeds with a lot of this because we didn't talk about it too much in the presentation. These both serve as things you may see in interviews, but more so what I want to talk about and hopefully reinforce is some of the intuition behind some of these concepts. Because I'm sure Zach and Virginia, like as you've been going through the technical books, there's a lot of stuff going on here. So it's kind of hard to understand and keep track of everything. Okay, so very much with the enterprise value, an equity value calculation at the bottom here, it's just a straight up calculation using information from the balance sheet. And so if we look at equity value, you can see it's just tied to the current value of the market here. And this information is drawn from Yahoo Finance or online market information. So you can get what the current market is evaluating that company to be. So after we get that information, we take out things we find from the financial statements. So there'll be some cross sheet connections here, just verbatim based off the equation for how we calculate enterprise value, working through the different numbers found on the balance sheet, and then ending up with our enterprise value. And so why is finance complicated? Finance is complicated because you have these equations, and then you have these different line items that you need to search for, both in the financial statements, but also in terms of market value, like on Yahoo Finance or in other sources. And so you're combining a lot of data to calculate this simple number in enterprise value. Like Cooper was talking about earlier, there are actually two ways to calculate enterprise value. So you have the balance sheet method, which is what I was talking about with the referencing to the financial statements, and then also the multiple method. And so what we have are one, information from the market, but also some comparables that we use to understand what the heck is our enterprise value. And so some of these numbers come from Yahoo Finance, can be plugged directly in terms of the number of outstanding shares. And then some of these are just generated by calculating numbers based off of what you have. So any questions about enterprise or equity value? Does this flow make sense too, I guess? And I'm moving too slow. Many questions, but I want to hopefully provide value for the time you all are investing here today.
It's making sense. Yeah, this is really.
All right, am I moving too slow? Do you want me to go faster, or is this good?
This is good.
Okay.
Yeah, I'm fine with pace.
All right, so now we have an idea of equity and enterprise value, and everything from here is just going to start cascading. So what Owen talked about today is, hey, I want to value my company, but I want to understand how the market is also valuing the company. And so we have this thing called comparables. We create a list of different companies, understand their metrics, understand how they are performing and how the market is valuing them, and say, if this is how you're doing it, this is how this company should be doing it. And so we ask the question, what are similar companies within this industry or compared to our company that we're trying to evaluate? For example, Lululemon in this scenario, and generate a list of different statistics by which we can evaluate Lululemon. And so most frequently, what you'll see is this table of comparable companies, and then a list of average metrics so that we can create a general benchmark for where our company should be performing. So implicit in this is that we're not making our own assumptions, but we're allowing the market to make those assumptions for us. So within each of these numbers is a little bit of story about the company, what it's saying about Under Armour or Ralph Lauren or Levi Strauss. So for example, and again, this is very simplistic, but hopefully will paint the picture. If I go to my multiples of how the company is performing, and I'm seeing how the market is evaluating it, I may come to ask why this 3.0 multiple here is, or this company is being worth valued 3 times more than this company. And so when I look at VH Corporation versus PVH Corporation, one of the questions I may have is, why does this company perform better than this one? And what is the story that the market is telling for why that may be the case? So once I gather those comparables, I can take it to Lululemon, see how it's performing in respect to the market, decide like, okay, does that make sense? And do I want to use some of those market values to generate a value for my company? And so you can imagine where this would go wrong. Like back in the 2001 .com bubble, if I was valuing my company using comparables, well, the value I'd be getting for my company based off the assumption for the market would be astronomically higher than perhaps it should be actually be worth. And so we develop a series of methodologies so that we can create an understanding for the different values and assumptions that we want to impute on the companies that we are looking at. So this is the comparables, and in the table, basically what Cooper has you all doing is just getting some practice understanding what comparables are and some of the multiples that we use to compare across companies. Because you could imagine like revenue could be really high for company, but lower than other one. But that doesn't necessarily help us compare which one's performing better. And so we have these different multiples that help us evaluate that question. This will be important for the future. All right, I'll stop with comparables. Any questions about methodology, completing the table, or numbers in general? Is this fun?
It's interesting.
Okay. Yeah, maybe perhaps fun is the incorrect term for it. Okay, let's keep rocking and rolling. Discounted cash flow. So, what the heck are we looking at here, Kevin? Zach or Virginia, what is a DCF and why does it matter? Again, if we do not know the answer, that is okay.
The DCF is looking at discounted unleveraged free cash flows. So
Mm.
it's focusing on the intrinsic value of a particular stock, not related to their capital structure or equity and debt.
Yeah, that's perfect. And so why do we use discounted cash flow rather than comparables?
If you're focusing on the intrinsic value of the company, so what are the internal numbers looking like, rather than comparing it to the market, which is obviously could be affected by market prices.
Exactly. And you touch on the thing that we'll come back to again and again and again. Like, these different valuation methodologies are tools, and they have different assumptions behind them. So like you were saying, Zach, behind the comparables, that's market. That's what the market is assuming. What they're assuming about the company's growth, what they're assuming about the company's debt, their assumptions. And so the discounted cash flow are assumptions that we're making. So we have the power to decide what's going to happen. But of course, with that, we don't have the power of numbers. This is a story that we're telling for the company. And so this spreadsheet is the basics, the outline for what is required to define for yourself what is the value of the company based off of core assumptions. And so when we're looking at all these boxes, this interface for this spreadsheet, what we have in one area are the core assumptions that we're going to make when we're valuing the company. And the rest of this are equations that we use, channeling our assumptions to get to our end goal, which is going to be our equity value. And again, I want to come to reinforce that one, that point again. The goal of our valuation methodologies is typically always to get to equity value and enterprise value. And so that's why those two terms in particular are really important. So walking through what we have here, we make a series of assumptions based off of what we think about the company. How do we do that? Well, we can look at our comparables to say, how are current companies that are similar in the industry performing? And then how do I think that they should be performing similarly? Another way is I could tell a story about a company. So say, for example, Costco. I could tell this very simple story where Costco is kind of this lame company that has boxes stored up really high, and maybe their revenue growth rate's only 2% year over year. Or I could tell the story for Costco where they have this exceptional business model with an insane supply chain, insane brand name value that's going to expand internationally. And I could make the argument that their revenue growth rate is going to be 10% year over year. And so you can imagine, based off the story that I tell, based off the information that I channel about both the company and then some of its line items, that I can get a completely different value for what the company is. So we have those different assumptions that we make, again, coming from what we think the company is going to do, some baseline key driver information. So like same store sales growth, how many stores they're growing in an area, what we think the tax rate is going to be from 5 or 10 years out. We make those assumptions and then we carry them into our end goal of equity value per share. And so assumptions, that's how we get our assumptions. And then we make the different calculations or components that are key to discounted cash flow. What are the key components of discounted cash flow? Very much all you need here are the different titles that we have parsed out on the spreadsheet. And so like Owen was talking about earlier, it's kind of hard to see if you don't have a clear equation or if you don't have it all settled in one place. But perhaps the most helpful way to think about it is we have this end thing called equity value, and it is a function of everything that we have here. Primarily a function of our discount rate, which we calculate using beta, our assumptions we have about the company, of which the perpetual growth rate and the revenue growth rate is the most important, and then also the terminal value. So what are the pieces that make up discounted cash flow? Like people will ask you this, or yeah, discounted cash flow, the discount rate, the growth rates that you set on your company, and then the terminal value. Those are the three core pieces of the discounted cash flow. And if you take away anything about discounted cash flow, understand one, it is cash flows discounted to the present. And then the second piece, the components, the large buckets that make out cash flow. Assumptions, of which revenue growth rate most important, discount rate, which uses beta, and then terminal value. So that's what Cooper is trying to get to with this spreadsheet. And so we have unleveled industry beta that you can get by using the equations on the presentation, cost of equity, again, flowing through beta and also the equation for cost of equity, ultimately getting your weighted average cost of capital. After we get that, we can project out a cash flow using the assumptions, ascertain what our terminal growth value is, again, using our assumptions highlighted in blue, and then reach what our end goal is with equity value per share and exit multiple. So that was a lot. Are there any questions about discounted cash flow, comparables, enterprise equity value, or accounting at all? Because this is the most important portion of your technical interview that you will see again and again. And more stuff will probably surface as you work through this stuff yourself, or as you read more inline detail for the guides. But hopefully that should be clear as to what we're dealing with when we talk about DCF. Zach, Virginia, looking good?
Yeah, this makes sense, definitely.
Yeah.
Okay. Now, so I'm gonna try to wrap up here at 2, because I know you all have been on a long time, and it is break. I have to eat some lunch. So I'll run through LBO really quickly. And then if you all have any questions, again, please feel free to shoot me messages. This is my life's blood. This is my baby. Well, not my baby, it's Cooper's baby, but I do sort of enjoy this stuff. Okay, LBO, merger analysis. So what are we dealing with again with LBO? We're dealing with essentially a merger analysis with a ton of debt on it. And so the most important thing when studying LBO or merger analysis is understand what the goal is behind it. Like, why the heck am I using LBO model? Why the heck am I using merger analysis model? Well, leverage buyout model, I am a financial sponsor. So my goal is to understand when I sell this company 5 years later, what's my return on investment? So my goal is to use all the tools that we talked about earlier to understand what that return on investment is. Merger analysis, on the other hand, is what Cooper was talking about. If I take company A and company B and I run a fusion on them, will the company that results be better than the one than the parts that I started with? So like he was saying, it's a 1 + 1 = 3 effect. Like, does 1 + 1 = 3, or does 1 + 1 = 0.5? And so we measure that in merger analysis through EPS accretion, EPS dilution, which I'll be honest with you, I sort of get, I don't super get. Cooper is the technical master. So that's the broad picture. Like, we want to understand why we are using different valuation methodologies. And if we're doing so, what perspective am I looking at things from? So I'm a financial sponsor and I want to purchase Lululemon. How would I go about it? What's the story? Well, first I need to generate how much money I'm actually getting through debt and how much money I'm putting down myself. So the best analogy that people will come to time and time again is always this house analogy. You have your $25,000 down payment, and then you have debt that you accumulate in form of mortgage that you pay interest on. And so the sources is just very much that. How much debt am I putting down? How much equity? So I get my sources, I get my uses, and then I can evaluate, well, here are my sources and uses. How much is the company going to cost in total? And now that my uses equals my sources, so I can actually purchase the company, does this decision make sense? And so how do I evaluate that? Well, I take a look ultimately at its unlevered free cash flow. And is this company generating unlevered free cash flow in excess, like 5 years down the road, after I sell it and after it generates that free cash flow, will it be generating value in excess of what I paid for it? And so I take my income statement information, I plug it in at the top, and I calculate my free cash flow. Once I calculate my free cash flow, again, what is the goal for all valuation methodologies? I want to get my equity value. And so I go through a step-by-step process, calculating what's that final EBIT, what is the exit multiple? So how much am I selling the company for once it exits? What is that value? And let me rope in the debt and rope in the equity that I started with to get what that worth of the company is to me, a private equity owner. And so once I get the exit equity value, what I can do is say, how much money am I earning? What is my rate of return each year if I choose to make this decision? And so very shortly through some of the details, we can pull an exit multiple from our comparables. Since we don't know what this company is going to sell for, we go to history to say, this is what other companies sold for that were similar. Here's what mine could sell for. And so exit value is just the plain out dollar for dollar amount for how much our company is worth after we sell it, or what it should sell for. We take the initial amount of debt, we subtract out accumulated cash flow to get the ending amount of debt. Why do we do this? Well, we're using the free cash flow generated through those 5 years before we sell it to pay off our debt. And by paying off our debt, we can increase our equity value in this situation. And so we start with that exit value, which is this exit enterprise value. We calculate what the debt is. We subtract out to find what the value of the company is to me, the financial sponsor shareholder, and calculate the rate of return. Okay, that's LBO. Very quickly through merger analysis. This is, as Cooper said, probably one of the more complicated pieces and one you won't get as much, but just to talk through really quickly. Company A wants to purchase Company B to form Company C, which is a combination of Company A and B. Or, yeah. So how do we do that? Well, we start with, what the heck is Company A worth if I'm Company B and I want to buy Company A? Then there are different ways I can cut the deal. How much stock do I want to offer? How much debt do I want to put on the deal? How much equity do I want to put on the deal? And so important to that is the exchange ratio for how I'm imagining that exchange to occur. So if I put equity on it, I want to understand how many shares of Company B stock am I offering to purchase Company A for? So for example, if I'm Coca-Cola and I want to buy Pepsi and my stock is trading at 2 times Pepsi's, maybe, well, not maybe, two shares of, 1 share of Coca-Cola is worth 2 shares of Pepsi. So I'm going to make that ratio in exchange. Then we come to measure the debt on the deal. How much debt did I put on it? What is the after-tax cost of debt since there's tax shield due to debt? And then ultimately, what is my accretion dilution? M&A is all about accretion dilution. We want to know if the combination of the 2 companies is worth it. And so we have accretion dilution, and then we have pre-tax synergies to measure whether or not this will be a worthwhile project to have those 2 mixed together. Our final step is more so a product of the goal. So after we achieve our goal for measuring EPS accretion dilution, let me understand what are the new metrics for the business. So what its debt looks like and what its ownership looks like. And so important to understand with M&A is, to be honest with you all, like there's a lot of BS that happens around here. For the most part, if 2 companies want to merge, they'll sort of merge without a lot of regard to EPS and sort of explain things away with different synergies. But it's still important to get a benchmark for things, how things work through this M&A analysis. And so, almost on time. Wrapping everything up. Again, a lot of information. The key thing that is very helpful to understand is that progression from left to right, one, this cascading effect that you have from the financial statements and comparables into valuation methodologies, and then the goal. Always ask yourself when you're studying these different materials, what is the goal of this valuation methodology? What are the assumptions? And why does it matter? So discounted cash flow, my assumptions, I want to value the company. Leverage buyout. I'm a private equity sponsor and I want to understand what my return on investment is. Merger analysis. Does company A, company B merger make sense? Through the eyes of EPS accretion and dilution. And so we put all those together, and what we have is our investment banking technical proportion. So a lot of what I talked about is primarily this intuition so that you all have a broad overview of these materials. But what they'll ask you is some of the stuff with regard to accounting and walking through all the pieces. Of course, the intuition, and then some of those equations so that they see you at least studied and you have an idea about what's going on. Okay, that's 2. Any questions at all? I hope that was helpful. Like TBH, the number one impetus is to make sure these don't drag on too long, and hopefully y'all are accumulating value from this. So any questions regarding anything? And then we'll just close out for the day, I guess. Or comments?
Nothing from me.
This has been super helpful. Thank you so much.
I'm glad to
Oh,
hear.
yeah, of course, really helpful.
Right, that's good to hear. My number one thing is I don't like wasting people's time. So, because time is money and money is an item on the balance sheet. Okay. Did you all get this sheet, by the way?
Yes, yeah, it's
Okay.
emailed out.
Yeah.
Cool. So if you have any questions, just please shoot me a Slack message.
I'm just curious, what are your general timeline benchmarks for application, more broadly application season for the next couple months?
When you say benchmarks, do you mean like benchmarks for students or benchmarks in terms of our meetings?
For students, like how many, at what point how many applications should I have fill out? Like what kinds of things do you think would be, which goals should I be looking towards in the next 4 or 5 months?
That's a good question. So I think you all have a fantastic start. Let me just start by saying that. Application wise, typically what we recommend is once school starts, like trying to fill out 2 or 3 applications a week, more if you have time. But of course, it takes time to put the application package together. So 2 or 3 applications per week, and then networking either one person per week, or if you can, put together some more. So that's those 2 pieces. In terms of timeline, like getting a month by month breakdown, I'm not sure if they shifted the time more this year, but it seems pretty similar to last year. Like January and February will be your primary application windows, more so picking up in February. So that's probably where the bulk of the applications will occur. February and March, I should say. And then in March and April, you will actually start getting the beginning half or the beginning portions of interviews. So like first round interviews. And then into May, June, July is when the interviews really start rolling. And so when you're thinking about applications, bulk is probably February, March. So create some sort of infrastructure so that you're applying consistently and still talking to people. And then hopefully, this is to the point about meeting structure, we'll get, as you're saying, Virginia, a little bit more time so that you all have more reps underneath your belt with some of these technical pieces. So by March, February, and more so March, you all have a pretty good hold of everything that's going on, hopefully. I hope that answers your question. It's not like a clear ball, like a benchmark, but like the more you can apply to certainly the better. Like Cooper, I think, for example, first of all, Cooper is ridiculous. Let's just start there. Cooper is madman. But Cooper like talked to something like 100 or 120 people, and he put in like 200 applications for different positions. So this guy was just going ham. Of course, like not different companies, but 200 positions. So it's easier to recycle an application for a specific company. But I wouldn't say that's your benchmark. Sort of along the lines that like that's what Cooper did. All right. Anything else, or just call it a day?
No, this was just really helpful, really useful for me. It's a lot of it was more useful than me going over it by myself.
That's good to hear, Zach. I'm glad it was helpful for y'all. All right, I guess we'll call it a day then. Thanks
Cool.
y'all for
Thank you
coming.
so much.
Yeah, thank you very much. Really appreciate it.
Yeah, no problem, y'all. Peace.